This is the 2025 Forex Trading Empire Mentorship Program Lecture 3. The topic for this lecture is Element to a Trade Setup. We'll still be discussing on Element to a Trade Setup, and in this lecture we're talking about order block. An order block is a state in change of delivery. Whenever there's a state in change of delivery, where if price were trading to the downside and there's a state in change of delivery for price to trade to the upside, in that change of delivery, the candlestick that led to the change of delivery is known as the order block, because that is the main state in the change of delivery, and there's going to be a whole lot of order which was infused to the market for price to change its delivery. Understanding this concept that an order block is a state in change of delivery, when you look at the chart, you look at the chart in a way that you are identifying the point or in a point in a trend where there is a state in change of delivery. After identifying those points, those candlesticks that led to the change in delivery is the order block. In this diagram, you can see that price is trading to the upside. We have 2 up close candle, 2 down close candle, 3 up close candle. First, price created 2 up close candle. Now, there is a state in change of delivery where price is retracing with these 2 down close candle, which are 2 red candles. Price was trading to the downside during this 2 down close candle. Then all of a sudden there's a 3 up close candle running this high. In that state in change of delivery, this 2 down close candle is the order block, because there's a state in change of delivery from a downtrend to an uptrend, from 2 down close candle to 3 up close candle, leaving a fair value gap. This state in change of delivery, price was trading to the upside. Seeing a down close candle is a downtrend inside an uptrend. Is an internal downtrend. If you go to lower time frame, this will be like a trading lower, just like a retracement, a sell side delivery. Inside a higher time frame uptrend, that's a state in change of delivery. The 2 down close candle traded lower, price traded higher again with 3 up close candle. The 2 down close candle is the order block, because that's the state in change of delivery that led to these higher prices. So understanding the state in change of delivery is understanding the order block. So the order block is the state in change of delivery, which is these 2 down close candle. Now, in some example, you might see one candle trading through in a state in change of delivery, where maybe in an example there might be more than 2 candles, or maybe even one opposite side candle in a downtrend. But in this example, there are 2 up close candle. Then there is 1 down close candle trading lower with a high impulsive momentum, running this swing low. Seeing this impulsive candle running the 2 up close candle is telling you that there's a change in state of delivery, and this candlestick is a high impulsive candlestick. You can still call this candle an order block. The 2 up close candle is still an order block because it's a change in state of delivery. Price was trading to the upside. This is the exact moment where price traded lower with an impulsive move. In one candle run through an opposite side delivery is an order block. So the one candle that run through this opposite side delivery, which is this 2 up close candle, is telling you that the 2 up close candle is an order block because it is a change in the state of the delivery. So understanding that the first scenario of an order block is to see a minimum of 3 candle where there is a fair value gap between the candles, between the 3 candle. After price running out the high, you need to identify a fair value gap to validate the order block. While the second scenario is to see a 1 candle trade through. A 1 candle trade through is also an order block. You can also identify it as an order block because the 1 candle trade through is telling you that there's an impulsive move where in fractal time frames, Maybe if this were a 4 hour, maybe in the 1 hour time frame or in the 15 minute, there will be a fair value gap between the swing high to a swing low of the candlestick that traded through the opposite side candlestick or the opposite side order. There will be a fair value gap within the range. So understanding the two scenarios of an order block, the first needs to have a fair value gap. If you see a swing low to a swing high where there's a fair value gap within the range, you identify the change in state of delivery, which is the opposite candle as the order block. And if there's a one candle trade through an opposite side delivery, which in this example, two up close candle, the two up close candle is an order block. It might be one up close candle, it's still an order block. Understanding this concept about an order block, we'll be moving to a chart to show some few examples. We'll be identifying a few order blocks and I'll be explaining how to internalize the order block to your analysis and know how to pair it up with a fair value gap. Now we're on a 4-hour time frame of Hero JPY. On 4-hour time frame, you need to understand that whenever identifying an order block is to look at the trend in an instance that you're looking for the change in state of delivery. First, let's talk about a buy side delivery. How to identify an order block on the buy side delivery. Now, during the time price traded lower, went through the swing low, then you can see how price kept creating an up close candle, trading higher till price run out this swing high. Now, seeing the price run out this swing high, price did it with the multiples of candle. It did it with 1, 2, 3, 4, 5 candle before price run out this high. Now, I can't identify this candle as an order block till I find a fair value gap. If it was one impulsive candle that traded through the candle, then I can identify it as an order block. But the fact that there are multiple candles and there's no fair value gap within them till the last candle, this candle created the fair value gap. Seeing the fair value gap, after this candle created closed, here's the first fair value gap, and here's the second fair value gap. Now, this fair value gap will validate the order block, making it a valid order block. Now, where is the change in state of delivery? You can pause this video to identify it, which clearly you can see it's that is this candle. Here is a clean state in change of delivery. Price was trading lower, run out this low, then you can see how price changed the state of delivery, started trading higher. This is where they infused the order that led to higher prices. This is where the algorithm used in changing the delivery. So this candle is known as an order block. We can identify it as an order block. Now, in an order block, the most sensible part in an order block where you look to take your entry, if an order block has a wick above it, then you set a limit order at the wick, or you look for price to react from the wick. Let's make this orange. You look for price to react from the wick. Within this order block, you can see that there's a wick in the order block. The wick and the opening price of the order block are the most sensible parts in an order block. Why? What makes a order block not that valid is when price trades below the mean threshold of the order block. Now, what's the mean threshold? You measure the body of the order block. Measure the body of the order block. The 50%, below the 50% makes it an invalid order block. If price were to retrace and go below the 50%, there's a high chances that price will trade through the order block. An order block doesn't mean is a support or resistance area. No, an order block is only telling you that there are order resting at that candle. That if price were to trade higher, price might retrace to the candle. It's not compulsory for price to trade to the candle and respect the candle. No, price might trade through the candle. You're only identifying areas where there are orders that will lead to a retracement where if price were to trade higher and price is trading lower, that will lead to a turning point in price because price have used that exact moment in price, those price limits, to shift structure before or did a change in delivery before. So there's a like chances that price will use that same moment to change the structure or to shift the structure, to change the state in delivery. That's what is an order block. Not compulsory that an order block will lead to a complete reversal or it will always lead to price trading higher. You need to have a narrative to back the order block, knowing that price is ready to deliver an buy side delivery or a sell side delivery, which in this example, I'm showing you when price is ready to deliver a buy side delivery. Now, whenever price does a retracement that goes below the 50% of the main threshold, with how to measure the main threshold is place a fib from the swing from the opening price to the closing price of the order block. The mid range of the body of the candle is the main threshold. If price goes below the main threshold, it makes the probability of price respecting the order block a low probability. But when price doesn't go below the 50%, we expect mostly the wick of the order block. That's the high chances of price trading higher. If you're looking from a higher time frame perspective, seeing a reaction from the wick of the candle gives you a high probability to look for intraday setups. Now, price traded to the wick of the candle. We expected the wick of the candle not going below the mid-range of the wick of the candle, trading higher. Now, the moment price trades higher, you can identify an order block. Here's the order block. Let's adjust this a little bit so that we can see the order block more clearly. Here's the order block. Because when price was retracing, during this time price was moving back and forth, price tried to trade higher, failed, then led to these lower prices that traded deep into the order block's wick. The next candle traded through, and then the candle after this candle traded higher, creating a new swing high. Now, the last state in change of delivery for a downtrend, for a down close candle before price created this two up close candle is this candle. You need to understand the momentum. Let's zoom out closer. Let me explain the momentum when identifying an order block. You need to understand the momentum between individual candles. First, price traded to this fair value gap, right? Price traded to this fair value gap the first time. Price tried to create a new high with this candle but failed. And this is an up close candle. You need to identify the up close candle within the downtrend because that tells you the momentum. Price tried to create a high but failed. The next candle traded lower, did a state in change of delivery, trading deep into the fair value gap, heading to the order block wick. Now, marking an order block, what makes this candle an individual order block is because there's no two down close candle after price failed to create a new high with this candle. There's only a one candle trade through. If there were two candles, then those two candles would be an order block. It's not the last candle before the downtrend. No, it's the state in change of delivery. Here's the state in change of delivery, traded into the wick of the order block. The previous order block we identified led to this higher prices trading higher. Now, a retracement to this order block will look for price to respect this order block. Now, there's no wick in the order block, which means we'll be using the body of the candle. Whenever there's no wick, use the body of the candle. But make sure if you're using it as an entry, your stop will be below the swing low, just to have a protective stop, because sometimes price might use a wick to go below, but price wouldn't go below the mid-range of the order block, which you can see clearly. There's a fair value gap that makes it a valid order block. If it was a full candle closed above. That already verified it, but it used 2 candles to create a new swing high. That makes it, we need to wait for a fair value gap, and you can see the fair value gap here. Let's make this blue. That makes it a valid order block. Now, look at how price traded back to the order block. Here's the order block. Price traded back to the order block, used a week to go below the main threshold of the order block. But remember, even though price used a week to go below the main threshold, it's still a valid order block as long as there's no full candle closure or full candle closure below the 50% range. That is the main threshold of the candlestick of the order block, which is a candlestick. Price used the week, went below the main threshold, went back, closed. This next candle led to higher prices. You can see how prices were expecting the order block, indicating that if price were to trade higher, this would be a turning point for price to do a reversal. Price traded higher, created 3 up close candle. Now, the moment price used this impulsive move to trade through these 2 down close candle, making a state in change of delivery, it makes this 2 down close candle an order block. First, price traded to this first fair value gap, tried to trade higher, failed. This candle traded through. Although price did create a new swing high, right? Price did create a new swing high, creating an order block. This is what I'm trying to explain, that it's not all order block that price will expect. You need to know with that we're trying to use probability to look for specific areas to execute our trades, or specific areas where price will react to. This impulsive move leading to the price running out this high, price created an order block. Here's a change in state of delivery. Now you can see that price traded to the order block, but price traded through the order block because it's looking at the order block as a liquidity to run out the swing low, because price is going for the order block below. Price traded to the order block below, try to create a new high, try to create an up close candle going higher for the swing high, failed. Then this candle created the change in state of delivery into the main threshold of the order block, failed to create a candle close below the main threshold. Then the next candle traded higher with an impulsive move running through the 2 down close candle. That makes those 2 down close candle an order block. And price will reference back to it if price were to look for higher prices. If price were to trade to it and price is still intending to create higher prices, price will look at it as a reversal point. Here's the other block. Let's make it orange. Price failed to create a new swing low, running out this swing low here. We're expecting the other block, create an impulsive move. Now, here's the other block. Price used the week to go below, but price did not actually traded to the other block. Came close, but there's a fair value gap within the means of the other block. That's why you need to understand both what's a fair value gap and an order block. Because in most cases, a fair value gap still holds that power to create a resistance or a support in price delivery, either a buy side or a sell side. You need to understand it. Price traded back to the other block, but price did not actually reach the other block. It stopped at the fair value gap, respected the fair value gap, created an impulsive move higher. Now, we identify how price respected this first order block, create a new swing high, retracement to the second order block we identify, with all the rules met. Then the third order block, price traded lower, came close to the other block, but not actually traded to the other block, but traded higher. Now, this last swing high here, you can see this impulsive move, price traded lower to this fair value gap. That same move, price created a new impulsive move trading higher, leaving this 2 down close candle. This 2 down close candle, you can identify both candle as an order block. You just include both the candle as an order block, looking for price to respect its if price were to trade higher, looking for price to use it as a support area. Now, we just marked out, I think I've explained more on how to identify a high probability order block and how an order block do works. Now let's look it on a sell side delivery scenario. Now price is trading lower. Remember, this is actually not hand pick. I'm just moving through the charts to look for a best scenario. First, let's talk about this one candle trade through. Now, here is an order block. Now, what makes this an order block? Price was trading lower, traded lower, tried to create an up close candle going higher, but failed. Even though there's a fair value gap here, I wouldn't look for price to come back to this fair value gap. The fact is that seeing this impulsive candle, that price failed to create much of a candle. Here's the state and change of delivery. Creating an up close candle showing that price is trying to trade higher. Then the next candle showing a down close candle trading below the candle's wick, doing a complete run through. This one candle is showing that this candle is an order block. And you can see how price respected the order block. This first candle traded back to the other block, expected it, traded lower. The next candle traded into the other block, expected it, traded lower. Now, during the time price traded lower, you can see there's another change in state of delivery. Price was trying to trade higher, but failed, traded lower. Here's another order block. Looking for price to respect this order block. In a case like this, where you look at the previous candle that created the swing low, and you see that there's a high wick in the candle, maybe like this, in this example, you can see there's a long wick in the candle. Price might reference back to the wick. In some cases, might do a retracement deep into the order block and go for the wick. The reason is that on lower time frame, this is still included as an order block, because on a lower time frame, there's still a candlestick around this area. Let's look at the 1 hour. Let's see if it was at the 1 hour. Now, here is it. On a 1 hour time frame, you can see that, look at how many candle the price used in creating this order block. It used 1, 2, 3, 4, 4 candles. 4 candles is the order block on the 1 hour time frame. But on the 4 hour time frame, it was just one candle we used this rectangle to identify. Now you can see how using multiple time frame, understanding the narrative helps you. That was the reason price traded deep into the order block from the 4 hour perspective. But if we were to use the fib to measure the 4 candle order block, you will see that price traded to the 50% range, resist from the 50% range, started trading lower. So understanding an order block is very crucial to your analysis. Understanding when you are anticipating an up close or a down close candle is very important. Seeing price trading to the order block, price respected the order block, did a shift in market structure, and there's still more order blocks to identify. You can see that there's a whole lot of order block in the chart. You just need to know the order block that would best suit your purpose. You need to have a narrative. Then you look for order block that is aligned with the narrative. Price do create order block because if it is a change in state of delivery, which means an order block is not that special in the way that you can say that every order block is special, because there are multiple order blocks, there are multiple change in state of delivery on a chart. You just need to look for the state and change of delivery that is aligned with your narrative. When you can identify candlesticks that are aligned with your narrative, those are the order block you pay attention to. Let's say I was looking to sell off the 4 hour order block, and price is creating an up close, a buy delivery order block. You can identify that here's an order block. You can do your own personal research to look at this price action. Here's an order block, respected the order block, created a new swing high. Here's an order block. I wouldn't be looking to take a trade off this order block instead I'll be looking for this order block to fail. That's why I tell you that an order block is not a verified support or resistance area. It's just telling you that price used that candle before to change a state in change of delivery. It used that price range to change the state of delivery, and price might use it later on to change the state of delivery. While in some cases, price might trade through the candle because it's no longer interested to change the state of delivery with that price range. Looking at this scenario, this is an example where you look for price to trade through the order block. Here's the order block. Price traded through the order block, run out the order block low, creating a fair value gap, leaving an order block. Traded back to the order block, respected the order block, did a shift in market structure, left another order block. Now, I'll be identifying this order block. Now, this order block is aligned with my narrative. I'm looking for lower prices of the 4-hour order block. And seeing an order block, 1, 2, aligning with my narrative. Here are order block you take advantage of. The same thing to this order block, the same thing to this order block. These order block align with your narrative. That's why most traders get it wrong that it's the last down close or up close candle before the impulsive move. No, it's not the last up close or down close candle before the impulsive move. You need to look at it as a state in change of delivery. There are multiple states in change of delivery. You identify the recent swing high to a swing low, identify the order block, look at it as a turning point in price. But a fair value gap can still lead to the turning point. So you need to include that to your narrative when going through your analysis. You just need to protect yourself by setting your stop at the swing high, not paying attention on the specific area price we use. You can either use the fair value gap or the order block, but you are taking account of the order block that this might lead to the turning points. Like in this example, price traded to the wick of the order block of this 2 up close candle, traded to the wick, price still traded higher with a wick, going for the fair value gap. If we were to look at on a fair value gap perspective, you will see that price were expected the fair value gap. If we were to look at from an order block perspective, you will see that price were expected the order block. So you can see you can't pick either of them. You just need to know your swing high and your swing low and set your limit order on the one most closer to your entry to the current price. So if I were to set a limit order, I will mostly set a limit order at the fair value gap because price is at the same price is already inside the wick of the order block. Is that I take a direct market execution, but if I'm looking for a skewed risk reward, I might use the fair value gap. But in most cases, I will tell you guys to just use the recent one that is close to price. Like this example here. Price created an order block with one impulsive candle, leaving this candle as an order block. Now, if I were to look for an entry, some would say that use the order block as an entry. I will not use the order block as an entry in this scenario. I will take account of the order block to put my stop above the order block, but I will use the fair value gap because the fair value gap is close to the current price action, to the current price at that time. So the fair value gap will be where I will set my limit order to wait for price to respect the fair value gap. But I can take account that if price is willing to go for the order block, my stop is already above the order block. And you can see how price respected the fair value gap, traded lower. So understanding an order block and a fair value gap is what will lead for you to understand market structure, which we'll be getting to that lecture later on. So that's all for this lecture. See you guys in the next lecture.